My name is Pete Santangelo. I'm with Wintrust Community Advantage. And you can find us at www.communityadvantage.com.
Brian Kelly, Senior Supervisor with Community Specialist, Property Management Company in Chicago.
And again, my name is Steven Silberman. I'm with the accounting consulting firm of PBG Financial Services, PLLC in Northbrook, Illinois, on Deerfield Road, 666 Dundee.
Okay.
GAAP audited, or it could be a compilation review. So the GAAP financial statement, it's going to be on an accrual basis. So the income is basically recorded when it's earned or billed, and the expenses are basically recorded when they're incurred, not when they're paid. So you have your true financial position. So what does that mean? So when you're starting your budget and your budget process, it's first great to see, okay, what happened last year? Sometimes when you're looking at internal, if you're self-managed, it's on a cash basis. So you're looking at expenses or income of what you received or expenses when you're paid. They don't necessarily tie out to your actual budget figures. So you don't really know how well did you really do. You can't really tell. And so that's why when you get that accrual basis GAAP financial statement, now you can truly see, here's what my actual billing was for the year. Did it match up with my budget for last year? Okay, now you can see what your actual expenses that were incurred were. And now you can see, well, how does that compare to what we budgeted? You got your true expenditures for the year. And this is where now we start helping associations, because that's the first thing I like to do. Then we start looking at, okay, where did we go wrong? Okay, where did the association go wrong? What expenses were higher or lower? Because that's one of the first things that I like to do. And when we start to help them with the budget process. So basically, once we've done that, then we can start looking into other things. But that's probably the first key thing. Once we've done that, then Pete, what then I'd like to look at is, where are your reserves with that, with the financial statement? And one of the key things is on these audited financial statements, it kind of makes sure that you're basically paying your expenditures out of the correct funds, okay? And that's the other key thing that these GAAP financial statements tell you. They're on a fund basis. And when you're starting to do your budgets, it's so important to understand what is your operating fund income and expenses and what is your reserve fund income and expenses. And if they get commingled, you truly don't understand, well, are you budgeting your operating to a zero budget at the end here or not? And so if you know specifically what is reserve and what's operating, it's so much easier now to start that actual budget process. So that's where we start with going forward.
So you're talking about comparison of last year and this year. But Brian, I think this year is going to be maybe so much different than prior years with COVID. What are some of the items that you should be aware of financing, doing your budget this year? What COVID issues should be included in the budget?
COVID has taught us many different lessons, and we're still learning from it. And now with this whole Delta variant coming about, when is this ever going to end? We have this end in sight. Not really. How do you prepare for it, and how do you budget? We saw a tremendous amount of use of the various cleaning agents and the non-reusable towels, the paper towels. Everything had to be thrown away. So you look at what your true expenses were halfway through the year. We were putting in general ledger number to account for COVID expenses and attributing it all to that to keep better track of it. Because general maintenance supplies, you've always budgeted X number of dollars for the year. It's cleaning the common element areas. Because of COVID, we've learned how much more often it had to be cleaned and how much more product was being used. So COVID also has taught us that it is just one example of unknowns. And are any of the budgets allowing for contingency accounts?
What about price increases? We've seen, the impact it's provided on vendors and employees, and just the costs, I think, of everything has gone up. How do you handle that now and in the future?
not knowing what the market's going to do and what the demands are going to be is what you have to be planning for. And what we're also recognizing too is because of short supply of items, and how do you budget? You have projects that you're planning on. I don't care if it's a capital improvement project or general replacement, doors, what have you. Supplies are in short order. And now if your projects are being pushed out 6 months to a year, now those labor contracts are coming into effect too. How much more do we have to put in for this project? Because you're going to be at a new labor rate. The cost of supplies itself, the supply and demand is truly hitting us. And manufacturers are not being able to get the materials out there fast enough. So you're paying a premium again.
Right. And see, I think that's a real key thing, because I think in the budgeting process, so many associations say, okay, here's what we budgeted last year. Here's what our actual is. Okay. And I think this is a real important year, just like last year really was. But even more important, because now we're seeing all these price increases, that associations have to do a lot more in-depth evaluation this year. Don't you agree, Brian? Because
Correct.
Now that you got these price increases, you just can't say, well, here's what happened last year, so now we'll budget the same thing this year. They really have to do more research to really determine things.
And it's across the board. It's not enough to say that COVID has affected the pricing on regular consumable items. We're looking at industry increases everywhere. Insurance is paying out more, charging more, because of all the payouts they've had. Your utilities and all of your regular basic items are all going up much more. It used to be a routine. Looked at last year, 3 to 5% cost of increase, figured out where we could be. Now we're seeing how much more has to be done to meet the demands, and those are the extra costs. So it's not a fair statement to say, oh yeah, last year, this year, 3% on this. The needs and wants of the budget this year is going to be truly different than we've had in the past. A lot more wants have been able to be added in because the needs weren't so high. Now the need is there. And when I speak of insurance, deductibles on any claims, things like that.
Yeah, I've heard that insurance premiums have increased substantially.
Right, and if you've changed your deductible to keep your overall premium down, well, on a $2.5 million budget, which can be small, can be large, depending on our audience with what you're looking at. But on a $2.5 million budget, if you're talking about a 1% increase, $25,000. If you've increased your deductible to $25,000, and if you haven't had it in your budget, and that's the real thing of the unknown effects. What do you have to do? And if you had to file a claim, $25,000 is coming out right off the top, 1% of your budget. And if the board is saying we don't want to increase more than 3%. Where are you taking from? It really is.
Right. And I think when Pete, you just mentioned about the insurance premiums going up, I think it's real important that the associations have to contact their insurance agents now to get a better understanding of what those increases could be. So I think that's extremely important.
There was a moratorium on foreclosures. With that lifting fairly soon, what about collection and delinquencies? I mean, I know a lot of unit owners were probably paying the assessments. Everybody I've talked to said they have not. If anything, their assessments collections have gotten better. Once that moratorium lifts, do you think, I think that everything will start shutting down, we'll be seeing an uptick in the collection and delinquency issues within the associations? What are your thoughts on that?
Well, we all know that as soon as the courts open up, but the court system is going to continue to be slow as it notoriously has been. And so you're going to have that many more that through this time have been adding to your books, adding to that debt. So just because the doors open up in the courthouse to get them processed, you're still going to be anywhere from 18, possibly 36 months down the road before you can be turning some of these cases. So you have to account for what is your bad debt expense? What is the realistic potential of collecting anything? That goes back to you from the accounting aspect of it, Steve, as far as the old debt you've been carrying for the last 2 or 3 years is about time to cut that off because you're now going to be incurring this new debt. And I think it's a timing issue. Just before it gets before the courts, we're still going to be waiting and that money is going to be slow coming in. And how do you continue to pay your present day expenses when you have fewer of the homeowners paying in? And although you're right, Pete, we have seen people maintaining assessments, whether it be renting the units, what have you, the monies have been coming in, but where are they at with their bank? Because you go into money problems quicker with assessments than you do your mortgage.
We have a
Right.
question out there. It says, can insurance settlement funds received but determined not needed for repairs be transferred into the following year's budget as receipts? Or do these funds need to be transferred into reserves?
Mr. Accountant, that's on you.
Well, I think there's a key thing here. So if it's an insurance settlement fund
Right.
and it's for expenditures that you haven't done yet, again, it depends if you have an accrual basis statement or a cash basis statement. So if these insurance settlements funds are for a repair or renovation that you are going to be doing that didn't hit in this current year, then yes, we can show that as a prepayment and allocate that against the expense. Because
But I think, I'm sorry, Steve, but I think along that question
Yeah.
too was, if the settlement, let's go with easy numbers. If
Right.
the settlement was 20,000,
right,
the manager and board have done a fine job as far as getting
Right.
great vendors. It was estimated through the insurance claim
Right.
to be
got
20,000, but it came
more.
in at 17,
Right.
right? And now you got this 3,000. Maybe that's what they're questioning as
so
well, is what to do with those extra funds that weren't needed.
Right.
Where do they have to be placed?
so they'd have to be placed in the current year. So if it's excess money that you did receive and you've made the expenditures in the current year, those are excess funds that would continue to be in that current year. So
And
and-
applied to what though? It goes back to the insurance expenses and it would just show as a surplus on their budget?
Well, basically, right. I
Okay.
mean, so there would be a surplus that could help your association out. If you are having financial difficulties, that will help you. So when you're comparing it to what your budget is or where your actual operations are, that is additional money that you did receive in that current
And it
year.
can stay in the operating as opposed to being forced into reserves. I think that was the other portion of that question is, you've got a surplus of cash.
Right.
Do you have to put it into reserves or can it remain in operating for yet another unknown?
Well, yes, because technically the money that you're receiving should offset against those expenditures. So those expenditures are being paid to the operating fund right now because you're paying the funds out of the operating fund unless you put the insurance money into there to pay for it. But basically, it is just excess money that you did receive for the current year. So technically, it isn't reserve fund money unless the board wants to do,
Sweep it in there.
right, unless they want to do, and part of their board meeting minutes, they want to say that we do have this excess funds, we'd like to transfer that over to reserves. Okay, then they definitely could do that.
And it wasn't asked, but those funds should be kept separate too, for the use of the project that they were given to.
Well, right. I
But,
mean,
yeah, correct. From when we
Yeah.
first get them, it's got to be
Gotta be
designated for that
designated.
project. If you get extra funds, you got your project done
right.
and you have a few extra dollars left over, then you.
Right, it depends how big this insurance claim, what the issues were. If this is a huge thing for a few $100,000 or something, well, yeah, then you'd want to set up, like you said, Pete, set up a separate account to make sure you're not using those funds for the wrong thing.
Right.
So now here you have an operating deficit and all of a sudden you're using that money for that. And now you don't have the money in order to make those renovations. So you're absolutely correct. That is very true. And I just wanted to go back to one more thing.
Let's go back to the budget. I know contingencies, you hear pros and cons, and I don't know if this is what you wanted to bring up.
You got it.
Okay. But you hear different stories on whether you should have a contingency or, in the budget, if you should have an operating debt for repayment contingency. But can you guys speak to that? Is that something you recommend? Is that something you normally do? Are contingencies good? Should they be included in your budget?
I have a small association that has a $20,000 contingency, and what they have found is that they want to do projects and they have their wish list. And so those monies are there that in case any of the projects that they have planned for, that for whatever reason comes in slightly over. How does that happen? Well, you designed your lobby to have this. You wanted to get that little bit of upgrade because your doormen are so good and you get them a better desk. Now you've got a $1,500 overage. where's that money gonna come from? What it can show on your budget is that you went over on a lobby renovation, or you can tap into that contingency and say, hey, we now reduce contingency by that $1,500 extra. All too long ago, they reviewed as slush funds and they got people really see about where's that money really going. The way contingency fund could work is by having the numbers and then at any board meeting recorded in the minutes, what exactly you're spending the money and how much and the reasons why. And as long as it's duly recorded, then that whole question of where did that $20,000 disappear to? It's accounted for. It shows in the monthly financials exactly where it was spent because that does have a GL number. The monies are accounted toward and the description is there.
No, you're absolutely right. And I think the other key thing, Brian, and I want to get your viewpoints on it too, is I think when associations are doing their budgeting now, they should have a budgeting contingency line item. Especially we talked about possible delinquencies and where things are going. You've already know on some associations, if you're having delinquency problems as it is, well, here you're doing a budget as if you're going to receive all the money from everyone.
Correct.
So now if you aren't and you're already seeing your association is having some issues, I always recommend that they should put a contingency in there for possible bad debts or possible collection issues that they have. You know, so
Correct.
I think that's key. What is your thought?
And that's where, you know, back to the beginning, how does the finance committee, how does management, the treasurer all work together on this? We all see historically what our residents have been doing. Have we seen a huge uptick in sales or leases? Will these accounts become questionable? If your association has been steady with the regular residents living there and everybody's been paying on time, well, then that questionable income or bad debt allowance can be minimal. It could be a percentage of 2 or 3 units total assessments for that year. But if you're seeing a huge uptick in transition at your association, you might be needing to allocate more money because you don't know if those newcomers are going to be paying as well as the present residents that are there.
So I guess from what I'm hearing, you both are in favor of putting a contingency within the
Yes.
budget.
Contingency is one, but then your bad debt expense would be another line
Right,
item that
right.
is also helpful.
Right, because you have contingencies like for, God forbid, it's a cold winter, your electricity comes out more, there's more snow. So there's
Excess
other
salt
contingencies.
usage.
Right.
Okay. We have a couple questions. If you have an operating deficit, I assume you pull the money out of reserves to cover the costs. Is that correct?
No.
Yes. I was waiting for that.
So, I mean, because here's what happens. You basically have a budget, okay? You've told everyone what is operating assessments, what's reserve assessment. So now you've put those reserve assessments into your reserve fund, okay? And we haven't gotten talking into it, which we'll get into more later, that you have to plan for the future for those reserve items, for those major common element components that need to be, may have major repairs or renovations on it. So now you've got that money in there and now all of a sudden you have an operating deficit, okay? And you start pulling all that money out. What is going to happen now if all of a sudden, and we'll get into this more later, that you have some major repairs or renovations that have to be done, and all of a sudden you borrowed all this money out of your reserve fund and you don't have that money available now for these major projects. Well, guess what happens? Now you have to special assess or you have to borrow money from a financial institution. And it could be that there could be some homeowner out there that could say, hold everything. You haven't done your fiduciary responsibilities because now you took our money out of reserve to use it for operating. Now we're short.
But Steve, on a short-term basis.
Yes.
And
Okay, I
I'm
was
wondering
going
if
to
that's
get
where
into
the
that.
question was going to, of a short-term basis.
Right, you
at the
got
end
to
of the
cover
year,
it somehow.
Right.
You have to cover it somehow, right?
Absolutely.
So you create a due from due to
Correct.
reserves from operating.
So, right. So there's two different things. You're absolutely correct, Brian. I was going to get to that.
Thank you.
So
Okay.
the real key thing is on a short-term basis, sure, you can borrow as long as you're going to pay that back. I always recommend that if you're going to even do a short-term, I would put it into the minutes and say, hey, we're going to be
Okay.
borrowing these funds for 3 months, 6 months, or even if you're going to be borrowing it for longer, if you put it into the minutes and you have a payback schedule and you even have an interest rate on it possibly, because now your funds won't have interest on it, then I could see doing that. So you're absolutely correct.
And some, sorry to interrupt
Yeah,
you
go
at that
ahead.
point, but, and there are some declarations, and you have to be very careful too. Some declarations will spell out, if you incur a due to, due from scenario, it must be paid at the end of that fiscal year.
Right.
And how do you get it paid? Well, maybe it's the special assessment,
Yep.
maybe it's a loan from a financial institution, but there are very tight parameters in certain declarations. Some will have a due to, due from that can carry on for years, and they pay it down accordingly, but it should be reported.
Yeah, see, you just hit another important point. I don't think enough associations go back and look at their bylaws and declarations, because there is so much information in there that they might find out that they're not doing. So that's a real key thing. Everyone should be going back and reviewing those bylaws and declarations all the time.
You don't have to read them stem to stern. You
Right.
have to just look at the financial aspects of your declaration. There are very,
But you should have a good understanding of them
The overall,
prior to
correct.
starting your
Yes.
budget. If you haven't
But
looked
let's-
at them, take a look at it.
All right, but going back to that person's question, so now we kind of answered about the borrowing from the reserves, which we can say you could do as long as there's plan, but not borrowing long-term and not repaying it back. Okay, but the other key question that I get a lot of times, Pete, is let's say the association is having operating deficits. Can they go to a financial institution and borrow money to pay for operating fund deficits? Not talking about long-term reserves or reserve funding, but just for operations.
There are specific lines of credit that can be used for operating deficit. But again, typically the bank will set it up to make sure that they're repaid, so that they're either repaid in the current year or the upcoming year that they were borrowed. But depending upon the size of the association and depending upon the cash flow of the association, there have been lines of credits that could be set up for a shortfall in the operating budget.
And is there any covenants or certain things they have to meet in order to borrow that? Is there certain?
Well, you would fall under the
Requirements?
parameters. Again, every bank's going to want to be repaid. So they would, usually have to have a relationship with the bank. And the bank is going to look at, what are they contributing to reserves? Because that may be a way that they could utilize that money to handle the interest costs. If there's any excess operating budget that they have, that would be looked at too. And of course, they're going to look at your delinquencies in the association. So, I mean, you have to meet the bank's underwriting criteria, which we'll get into in shortly. But yeah, there'll still be typical requirements that the bank will want to see before they extend the obligation to the association.
what is the minimum relationship the bank would require? It's not going to be a $5,000 CD and you're going to loan them $300,000.
No, they're gonna want a relationship either with operating and reserves that are with the bank,
Okay.
because again, they're giving them the loan with the repayment on the expectation of the cash flow of the association. So
Okay.
they're gonna want to see a relationship from the association.
Okay.
Are there set dollar amounts, Peter? Is it all based on percentage as far as, do you have to be holding 200,000?
Every bank is different with
Okay.
their criteria on what they look at. We will look at what they're putting towards reserves and kind of maybe look at 1 or 2 times the contribution to see what we could set up a line of credit for their operating budget. But every bank has different qualifications for that.
Okay.
And what happens if it's just a loan for operations and they can't pay it back? What happens at that point?
It would trigger default. So then the bank would you'd have to meet with the association to come up with a game plan as to how you're going to handle the repayment. You'd probably term it out to come to a 2-year, 3-year, 5-year repayment plan to have it be fit into their budget, whether they increase their assessment, whether they implement a special. to repay that loan that they're taking out for the overage and the operating expense. And that's why every association, every bank will have different criteria that they're looking at. And usually that they stipulate that there's a relationship there with the association. So we kind of diverged. Going back to budgets, we talked about the increase in COVID, and we talked about wants and needs a little bit. But what would those items be that an association may look at dropping off or reducing in their budget? I know everything is important, but can you get into the wants and needs and some line item that they can look at as to where they could possibly cut costs?
Every building being unique, and that's what if they kick down the street the longest? And so those now become the real true needs. When you look, and it can be anything. You know, if you really truly haven't updated your lobby in 7 or 10 years, that paint job can't be put off any longer. But if you just got it re-landscaped and you're not happy possibly with the floral selection, does it really mandate that you spend the $20,000 to redo the flowers just because 2 of the new board members aren't happy with it? Probably not a prudent means to expend, right? So that's what it really comes down to, is looking at your historical aspect, going into the year coming up. What did you budget in the current year that you didn't get around to that's now gone from a want to a need? You really do need to adhere to curb appeal. If you're going to keep the units being able to sell, what are prospective buyers seeing? And that's the biggest thing, is the cleanliness. And so how do you determine what is most important? The board is going to drive that. It's also going to be driven by what the rumblings or the expressions of the homeowners have been. Your manager certainly gets an earful from the over participating homeowners that speak their mind each and every day. So that all gets factored into the budget process. And what are they hearing? You know, what is it? Amplitude, how loud something is being spoken about and how much it's being spoken about. So you've not put the money towards your hospitality room, but yet you want to rent it out for $200 for private parties with furnishings that are 20 years old. You're not going to get your $200. And so there's where you start putting money in. Where can you cut away from? Like I just said, what was most recently done? Does it really need to be spruced up?
How about like landscaping? Because
Right.
that's always a key thing that I hear, you know, that when the summer comes, a lot of associations want to do certain types of landscaping, whether it's bushes, whether it's flowers or whatever. How have you been handling that?
Having been a city supervisor and manager, I've always had very limited landscaping, right? You go out there and cut the grass with your desk scissors. But anyhow, for the suburban night managers and that's a huge portion of their budget. And it really comes down to speaking with the landscapers. It's amazing. The more flower beds you fill with grass, it's a whole lot less expense. So there are many things that can be done utilizing your experts. So you talk to your landscaper, but now maybe it's the landscape designer. This is applicable to any aspect of your building about where or how to cut costs. When you're looking at a hospitality room or a lobby for upgrade, you're talking to your architect, you're talking to the designer. What could give us the biggest splash for the least amount of money? You know, if you have unbelievable resources and you're really trying to spend down a reserve fund that has gotten, you know, almost too large, right? Do you really need $4 million for a 200 unit building? Maybe not. And so you could splurge on things. But as far as from a budgetary standpoint, the needs and wants and what can you cut, that really takes the input of the board and the residents, because they're going to speak of what they have to have. And some will say, we have to do the lobby or we have to do the party room. And you know what? We're not going to have as big a holiday party. You know, we'll do.
So what may not be important to a few may be important to the mass, and
Correct.
you have to go with what the mass wants to do.
And see, and this is where that finance committee, if you're a bigger association, comes into play, because you're
Correct.
getting more feedback from more of the actual unit owners on what you could cut back on and what you can't.
And when we really look at the budget, there are so many line items that are musts. You don't have wiggle room on contracts. You don't have wiggle room on union benefits and payment, right? So where are our ability to flop? It is the landscaping, it's the holiday parties, it's the renovation of the various lobby or party room. Management offices usually don't get upgraded. It's a cost center, right?
What about, and I know, we were talking suburban and city, but in the city, sometimes you have dormant. We're talking about increased expense. We're talking about the mandatory, $15
Minimum wage,
minimum
right?
wage.
And the union contracts have always been more than that anyhow.
And anyways, you can't negotiate with that.
Correct.
That's what it is.
And the other
that's
thing
something
too-
you have to think about. And
Right, and along those lines too, big difference was suburban and city. The city mandates that are now really hitting home. All those things that they used to have inspectors on that are now being third-party out. And it's everything from your canopy fees to how much the driveway fee is going to be. All those fees are going up. So when you're talking budgeting, it used to be, okay, $120 for a driveway fee in the city. Well, the city's going to turn around and realizing they've got a cash cow there, and they're going to start nickel and diming every one of us. And so those canopy fees, the boiler fee, the driveway fees, your no parking signs, those are all regulated by what you have on it, and that's the city. And they are coming after us with increase. So when they talk about your association dues and fees, you have to belong to certain organizations. And you want to make sure that's in your budget. And a lot of people don't understand that, the importance of being members of CAI, Walmart, Hiram, whatever they may be for every association, it's important, but it's the what I call hidden fees that you just don't think about. And when you realize and you go through your GL about what you spent to your city, and it's true to the suburbs too, you have your municipality fees out there, I'm sure. And you have to really be mindful of that, of what they're going to hit you for.
yeah, we have a couple more questions. A couple are on loans, which we'll address when we get to that topic. But one asks, is there an actual line item called contingency fund?
There can be, and you can grade it. It is a GL, and you can do that. And then if you have some type of budget narrative sheets to go along with it, you can explain what you're predicting or forecasting for that may need to hit the contingency fund. Again, it goes along that line of needs and wants. You're going to do these certain projects. You have it planned for 50,000. It's coming in at 55 or 57 because of the increased cost that we're not so familiar with right now and haven't been able to put our fingers on it. You're going to spend more to expedite it because you want it done this year. And the vendor is saying, well, to get it from the manufacturer to you, expedited cost is another $1,000. So there's where you would put it. But I think if you're going to do a contingency fund in your budget shell or worksheets, should be spelled out where that money may be going.
Right, yeah, I have associations, if it's a contingency for bad debts, I actually have the line item that says contingency bad debts.
There you go.
So everybody knows up front.
Steve, you talked a little bit about, I don't know if you have anything to add. I know association's accountant being involved with the budget and the association. Did you want to touch on anything else that you haven't already about how the accountant can be involved?
Well, I think I talked a lot about our financial reports. That was the first key thing and probably one of the most important tools to be able to use for the budget process. But one of the other key things that we look at that I think is extremely important, I'm going to touch on a little bit, is commingling. And we've talked about this before about borrowing funds. And that's the reason I said that if you're going to borrow something, it should be put into the minutes of how much you're borrowing. So many times when we come in and we do our financial reports, we see that, a lot of the reserve type expenditures, which is these major common element repairs or renovations, are being paid out of the operating fund. And then sometimes they'll have the reserve fund reimburse the operating fund for some of the money, but not all the money. And so what happens with a lot of associations is they're not really looking at saying, here's the dollar amount that got paid out of operations. That was a reserve expenditure. And they're not reimbursing back the exact dollar. So we see this happen a lot of times. And it's not just the reserve expenditures, it's even assessments. And sure, we've seen where you budget every month the amount of reserve assessment that should get transferred over to reserve. But when we see other issues, and I think we'll get into later on, is special assessments. We want to make sure those get put into the right fund. So commingling is such a key thing. And we find that, I can't tell you how often we find it. It's a lot. When we go in to do financial reporting, we see that probably on at least 80% of the associations that we do compilation reviews or audits, that we have commingling issues where we'll get to the end of the year and then we'll figure out how much does the operating reserve fund owe the other fund. And that's where we want to make sure it does get paid back. Because like we talked about before, if you are budgeting for reserves, you don't want to be using that money for operations and vice versa. So the other thing we help associations with, which we'll get into hopefully later, is on not only budget consulting, but review funding policies. So we want to make sure, we get asked so many times, Steve, we got all these big projects coming up, we need help to make sure, can we do these projects? How do we fund for these projects? So especially within this last year, I am getting so many calls to help out associates, even ones that have managers with them, not only ones that are self-managed.
Yeah, we have a couple questions on that. Maybe we get into, how do you budget for your upcoming projects in the current year? Specifically, the obvious question everybody knows: a reserve study. What should you get one? What does it cover? We don't have a engineer here, but Brian, you've been doing this for a long enough time, and I mean, we can both chime in too. Is a reserve study important?
Reserve study is important because it's being performed by a licensed engineer, and sometimes you'll have different engineers coming in and compiling that report. You'll have a mechanical engineer, structural, coming out to see it. And so what that reserve study does, it is nothing more than a roadmap, and it's the engineer's best estimate, looking at a device, whether it be your elevators, whether it be the condition of a roof, seeing the existing conditions, when it was installed or applied, and what they feel is going to be the remaining useful life of it. And it is a true guess, but it's a educated guess, because you are looking at materials, you're taking into consideration, if you look at a roof, with our temperature changes in precipitation we have, right? So the engineer is going to look at it and say, wow, it was applied 5 years ago. It's got a useful life of typically 20 to 30 years. You've got a warranty on it. Yeah, I would start funding for this in another 10 years, presuming that if it's going to have a 20-year total lifespan, 10 years you start buying for it, put it in. So you have long-term and short-term of how that reserve study can go for you. There are going to be things that they're going to see in year one. So you're in 2021, you're doing your reserve study, should carry you for the next 5 years, but we all know it is estimated on present conditions, future use. If you have incredible temperature swings, incredible precipitations, that roof may not last as long. If you have huge changes in your building with constant move in and move outs, and you've got a spike in your rental, will that do the wear and tear on your elevators? And so that 7 to 10 year may now be shortened to 5 to 7 year. So that's why you have to utilize your reserve study. It's giving you a forecast 5, 15, 20 years out. Where are you at today? How many years have already gone past in this reserve study you're looking at? So when you're doing your 2022 budget, your reserve study is from 2018. You've got some age on that report, and how do you update it? And then you want to look at specific components. You don't have to do.
And you recommend updating it every 3 years, every 5 years?
Depending on the agent and where you're looking at it. I'm saying 3 to 5. And
Yes.
so, again, the reserve study and the components, and you're looking at it, has impacts in other areas too. You can go back to your insurance broker and say, wait a minute, why are you gouging me on these premiums here? We're a low risk. We've stayed on top of our reserve studies. We're doing the changes accordingly. We're upgrading our systems. Let me get a little break on that. The higher and better efficiencies, whether it be a boiler system or an HVAC system, whatever it might be that comes out when you're staying with the times instead of trying to repair something that's 40 years old.
Right. And the real key here is that I find this all the time. So associations get this research study and then they don't look at it. I mean, this is one of the things I find all the time. And we do compilation review reports all the time, or audits, and we have a footnote disclosure, and and we get hired to do this, and then we ask for the last reserve study report, and it's like 10 years old. So Brian, you're exactly right. It's every 3 to 5 years, but the real key is the board should be reviewing that study every single year when they're doing their budget process, like you were talking about, because that is one of the things you have to look at. What happened this last year? Did we do something that was forecasted in the budget? Like you said, it's a guide. So did we do something this past year that was forecasted in the reserve study for 3 to 5 years later, or even a couple of years later? So now you have to relook at it and say, okay, we did this now. So the board should actually be kind of revising it themselves and looking at it and doing their own revision. Because if you're going to go out to the engineering company every 3 to 5 years, you want to look at this every year and revise it yourself to make sure you're taking into these all these different things that are happening. Plus, I think the most important thing, and I think we already talked about it, and you already mentioned it, Brian, is price costs have gone up tremendously, number one. So your reserve study might have an estimate of a certain price, but the prices have gone up so much more, you really need to go back and relook at some of these costs, especially ones that you're projecting to do next year or 2 or 3 years. Now you have to relook at it and say, okay, now what do we need to do here? Because these costs are going to be so much more than we thought. So here we thought we were budgeting for the correct amount. Now we realize we're not.
And that reserve, I'm sorry, people, on that reserve study and what you mentioned there, Steve, you're absolutely right. Reserve study is saying, wow, in 5 years, we're going to have to do these 10 components. Well, guess what? Maybe you're looking at it and some of those items are a little bit more of the low-hanging fruit that aren't nearly as costly. And so instead of waiting for the 5 years on an item, you're a little bit more flush in cash this year. And you'll take care of some of those items on that reserve study you've been funding for. Now you're sitting with enough money to take care of that one smaller item, maybe not due till 2025. But gee, if you get it done now with the cash you have at hand, one less thing to worry about in the future, because maybe something else that had a 5 or 7 year useful life comes down to 2, and you have to pay for that now. So you have to look at your reserve study that way as well.
What about facade inspections? And then we had a catastrophic event in Miami, and we're talking about reserve study. Does it cover structural below ground? What about, and you think there's going to be any impact which will change that, mandating a structural repair? I know we've seen a couple of garage associations that are below an association that, and I think it's been in the newspaper too, that are now looking at getting the repairs done sooner rather than later because of what happened down in Miami. Yeah.
And that's the thing, people can all know that anytime you have a catastrophic event of any kind, it has its impacts, right? And then what do we learn from it? The bureaucracy of it all pushes things, and then it's always seems so late. You know, you look at life safety evaluation, and then it was the horrific fire, and then how that pushed everything up. Typically, your facade inspection is just that, the facade of the building. They didn't want anybody walking by and getting clobbered with falling concrete, right?
Because that happened.
Correct.
In the city.
Right? Traffic report this morning was the Milwaukee Bridge crumbling down over the road too. So the point being is that facade inspections, city ordinance, suburbs, not so sure on what the requirements are. But I mean, when I think of a facade for suburban townhomes, I think of all those decks that they have built. And when's the last time anybody truly inspected the bolts that are supporting all those balconies out there? But back to your point of facade and the requirements, the city ordinances does require it. When we talk about actual structural integrity, no, that's not been involved. Have we had some associations reach out and go speak to your structural engineering firm and find out? You can do structural integrity tests to a certain degree, as the engineers have told me. You can go down into the basement of the building. You can look in the parking structures where you'll have the support columns exposed. But do you truly want to go into the 17th floor, the 37th floor, the 52nd floor of a high rise and open up somebody's living room wall that has been the wraparound of the support column that's in their unit just to see, gee, did last year's rainstorm on the roof get into the 52nd floor here and affect our column? You know,
you got to look at the base and you got to look and then go from there.
Right, right. How do you benefit from it? If there's nothing indicative, if you're not having swelling, you're not having definitive signs. How deep do you want to get in this investigation? Because it all costs money. People do sleep better at night when they know that they've had somebody look at it. And we have. And I think that's where it comes down to.
Is there different structural issues for like the associations that are along the lakefront than there is that aren't?
Not being an engineer, Steve, but just having experience with some buildings along the lakefront, yes, you have the water table issues. You have the North Sheridan Road that we all know was built on the backfill after the fire, right? So you've got the ground difference. What were the pylons? How far does it go down to bedrock? And what the underlying structures are. Do buildings along the lake take on, I'm going to refer to moisture as opposed to water. I don't think there's anybody with standing water, but there are various telltale signs that you have to be involved in. And every building's aware of that along the lakefront, and they have their studies done accordingly. And the engineers certainly have their thumb on that.
So one last item, Steve, investment policy. I know that was one of the handouts that was provided to everyone that signed up for it. I think it's a valid and important piece of information that every association should have, especially with the transition of boards and how they turn over. There should be some document there that specifies how they should handle their reserve funds. Do you want to address that?
Yeah. So an investment, and it was just a sample one we gave out, of course. Everyone's going to be totally different than this one. But of course, you want to, when you're budgeting for reserves, one of the key things that you want to know if you're budgeting is how much interest will you be earning if it's going into there. And everybody wants to know, I mean, what is important to that association? Is it safety? Is that really important? Is it liquidity? Because one of the key things that you always have to look at is when are these projects coming up that you have to do the renovations on. So if you, let's say you decide you want to put everything in CDs, well, if you put them all into long-term CDs and you've got projects coming up, well, how is that going to help you? So one of the things when you're doing your budgeting and you're doing your forecasting, you also have to look at when are some of the major repairs or renovation going to happen? Is that in 3 years, 5? So you want to make sure you have funds available for those projects, number one. So that's a real key thing. And some associations, yield is extremely important. So you have to determine, do you want to get a little bit more aggressive or not? Or do you want to stay with things that are more safe? And the more aggressive you get, if there's any downturn in the economy, that will affect the amount of funds that you have.
Brian, any comment on that? A lot of your associations have investment?
When you have your investments and you have your reserve funds, and then it's always the equation of what projects do you have lined up for your reserve funds that you're going to be spending those funds down with? And then what is that safety threshold? Because if you plan to do certain capital improvement projects and you're going to take your $1.5 million in reserves, let's say, and you're willing to bring those down to 300,000, but then you have that catastrophic what if moment, the complete boiler system goes, and now you're looking at 100,000, 300,000, whatever the cost might be. When are you no longer safe for a lending institution giving money? Because what do you have in your reserves? And if you deplete them down too low, so there is that understanding during the budget process. What is our bare minimum we ever want to bring our reserves down to? Right. What is the safety net, and how do we still look attractive to a lending institution for upcoming projects? Because quite frankly, you might not have the money today, but if you're willing to pay for it over 10 years and you take a loan and you get that note, you keep your reserves at the level that is healthy for prospective buyers, and you budget accordingly for the repayment back on the loan while you're still either beautifying the property or making it structurally sound, or even just aesthetically appealing in any aspect.
And it's not just for a lending institution, I think, too. Education is out there and people are a little more sophisticated, that they're looking to see, where the reserve levels are, how they're funding for reserve. So, the association needs to make sure that they're paying attention to that to make their building attractive when they go sell.
Well, no, and I think you just hit it. That's exactly what I was going to say, Pete, is one of the key things, because we get people that come up to us as accountants and say, hey, Steve, we'd like to buy into this association. So of course, one of the first things I tell them is I want to look at the financial report. I want to look at their budget, and I want to look at the reserve study. So you're absolutely correct, because I want to look at what kind of funds they have in reserves and what the reserve study says and what's coming up. And more homeowners want to know that before they come in, because they're concerned that all of a sudden, after they buy into an association, they're going to get hit with a special assessment coming up later. So that's why it is so important when you're doing your budget, you look out to 3 or 5 years. You have to plan for this ahead of time. It's not something at the last minute you want to say, okay, oh, we realize next year we're not going to have the funds. We have to do a special assessment. We have to get a loan. You want to be planning this out way ahead of time, because you want to look into all these things. And I think, Brian, you already talked about that too. You also want to look at those costs now, so that if you have to go out for a special assessment or loan, you have a better idea what those costs are going to be next year and the next few years.
Yeah, I mean, we're seeing an aging infrastructure, and I know you mentioned special assessment or take out a loan for a capital project. You know, we've been seeing both because of deferred maintenance. We've actually been seeing a lot larger loans that have been provided to us to provide a proposal on. And you know, that happens because, again, as you mentioned, you can budget for what you know, but if you're mandated to do a facade inspection and have to do work, or you're mandated to look at your decks, or you're mandated to look at balcony, that's not in your budget. So you don't know what that cost is. And if you haven't been, you know, if that useful life in your reserve study said it's not, the repair isn't for another 5 or 10 years, yet you're mandated to repair it now, what do you do? What do you do? I mean, your options are limited. You either have to special assess, you have to see if you could work into your loan, maybe if you're paying for it out of operating, or your contribution to reserves, some time frame to increase your assessments before you term out your loan. There's limited options that the association has. So, you know, loan structures that we can provide are either a loan or a line of credit, or a combination of both. Again, it depends on the association. If they know this project's coming up, if they're special assessing for the project, they may then want to take out a line of credit with a loan option on it, so that they could go ahead and get the project done, pay for the interest cost on the line of credit, and then impose that special assessment that's been passed to the unit owners. Those that pay up front, the line of credit gets paid down, and those that don't then pay that portion over a time frame. However, there are a lot of associations that know this project's coming up and want to pay for it out of their reserve contribution. And in that case, you may want to go right for a loan. Since it's in your budget, you know the numbers there. Rates are still low. It's still a good time to take out a loan, and I think we'll see that for the next few years. I know inflation's kicking up, but you know, the government has mandated that they want to keep rates low, so we'll probably see that for the next couple of years. And you'd go with a loan, get your loan rate fixed, and pay it back over time.
So Pete, so what happens if, like, it's a project that'll take, you know, 6 months or 9 months or whatever to do the project, okay? And let's say the association doesn't want to borrow the money up front. First of all, would you recommend them to borrowing it if they know that they're going to have to borrow over 6 to 9 months? And if they do take the line of credit, and like you said, later on, they want to then term it out into a loan, are they going to get hit with a larger interest rate later on, or will the interest rate be the same if they take out the line of credit now and eventually term it out to a loan?
Most banks are fixing the rate because the rates are similar. I mean, with what your treasuries are and where and your line of credit is usually tied to a fluctuating rate. So what they'll do is they'll fix the rate over the line of credit and term loan. We've been seeing that a lot amongst the institutions that are doing this for associations.
So then it probably, in a case like that, if it's a longer project, it'd probably make more sense then for them to take out the line of credit. Because number one is, especially if they're having budget issues to begin with, or if they will eventually special assess, it helps them out in the meantime that they're only paying interest only before they term it out when they're going to have to pay principal and interest.
If they're special assessing, yes, but I would say no if they have the funds available to make principal and interest, because you're
Correct.
going to be paying less in interest costs if you start repaying the debt
Correct.
sooner rather than
Yeah,
later.
that's what I was asking.
Right.
Yep.
And then let's take that negative stigma off of special assessment. Back when I first got into the industry, everybody thought, oh, you only special assess because management didn't know how to budget and it was a lousy building. No, I think it's been a very advantageous investment tool because we all know once you increase your assessments, they're not coming down. And so when you know that project is 3, 4, 5 years out, and it's going to be X number of dollars, do you really want to continue to increase your assessment and increase the contribution to reserve, where after 4 years, you've really seen a 20-some-odd% increase? How do you ever sell a unit at that point? So knowing that a special assessment, well, then the homeowner can turn around and get their own 3, 5, 10-year note, whatever they want to do, and however much interest they want to pay. So I think that special assessment can be used as a tool, and especially if it is stated early and often and publicized very well. Huge transparency. We have to do project X in 2024. In order to pay for it, we need to raise the funds for it. And therefore, we're going to be implementing a special assessment for X number of dollars. You, the homeowner, can pay for it, either all up front, get a loan of your own. You know, there are certain associations that can fund special assessments and bring in the money and take on that debt, passing it on to the homeowner. There are
Right.
different ways of doing it.
And isn't it true then, Brian, too, if it's special assessed to the homeowner, if they sell their unit, that homeowner has to pay that special assessment, doesn't get passed down to the new buyer.
Correct, and that's why when you're talking about the buyers looking at what are on the horizon from the special or from the reserve studies and what is the board presently planning, you open up a conversation about a planned project. That's got to be noted in your 22-1. If you're having discussions about that at a board meeting, whether you've given it a date or not, if you start kicking around that idea, you better disclose it.
So does special assessment require any additional monitoring? I know we require a breakdown if there is a special assessment of a delinquency report. We not only want to see the delinquency on the regular assessment, but we want to see the delinquencies on the special assessment. And are there any additional fees that a management company may charge to manage a special or a loan?
I can't speak for all associations. There is a lot more paperwork and legwork done with it, and especially when it comes for sale and you have to do your paid assessment letters, exactly what was paid and how much and what was due, and at that time. So there is an accounting aspect of it that's a little bit more to deal with when you're dealing with the special. How were fees and that applied? It's to every management agreement. So, but there is more work in it, yes.
And regarding monitoring, and I'll take your opinion too on this, Brian. When we look at it as accountants, what we always recommend, if you're going to do a special assessment, and let's say you also took out a loan on top of it and you have to pay it back, what we'd like to see as accountants is this set up in a separate fund. So we'd rather see that the loan proceeds go into a separate account, okay, and the payments on the payments to back on the loan, the principal interest payments, get paid out of that account, and of course, any of the special assessments that you're receiving from the unit owners also get deposited into that account. Because one of the key things we don't want to have happen is here you're special assessing unit owners and that money gets deposited into an operating fund, and all of a sudden people are using it for operating and you have the deficit in your operating account, and now you're using the funds for something that it wasn't supposed to be used for. So we always recommend then that the special assessment should get transferred into this special separate account, and then everything, now you can track everything, okay? And then when we come in to do your compilation or review and audit, now we can see that everything ties out and there is nothing owed between the different funds.
The other handout you received was a Q&A on loans. If you're planning on or looking at taking out a loan, which, kind of covers some of the topics that we talked about. And we're at about 210 right now. So maybe I'm going to stop. And then if we have some more time, I'll go through what's required on the loan, but address some of these questions.
Okay.
So one of the questions is, how would you handle budgeting for a major roofing project we know has to be done, but we won't have final numbers from the engineering firm in time? We know we don't have enough in reserves to cover it, so it will need to be a loan, special assessment, or some combination of both. From the management standpoint, how would you look at that if you don't have the final numbers in yet?
You fear for the worst and you hope for the best. And how do you plan accordingly? The engineers have given you some type of situation, or excuse me, explanation for the situation you're in. If you have a total unknown, are you really going to be doing it the final year? And here's another one of those issues. If the roof is in that deplorable of a condition and it's going to have to be done, then you're just going to have to allocate the funds based on a worst case scenario that the engineers of the roofing company are presenting to you, and budget for it accordingly. And if that means prepared to do a special assessment, again, there are very strict rules on a special assessment. You have to have actual dollars or what this costs. You have to explain why you're special assessing. You just can't sit there and go
timeframes that you have to.
Correct. Yeah, and you have to have it paid by, correct. We're going to implement it starting in 6 months, and you have to have it paid within 18 months. And if it's, $2 million for the new roof, fine. But
then you have to have certain timeframes to call the meeting to
correct. Pass it all out. So the predicament they're facing right there is, how do you plan for it? Again, it is truly planning for the worst. And if everything could go wrong, and the engineers are telling you, if all of these things lined up and it's going to be a $3 million issue, plan for the $3 million. And if you come in anything less than that, you're gravy on top.
Yeah, and if you're looking to go to a bank to finance it, the bank can do you don't have to have an exact figure for a proposal. You can say up to $1 million, up to $2 million. The bank can take a look at it and let you know how you fall, whether you're going to qualify, whether you have an issue. They can even give you a threshold as to, okay, look, based on what we see, this is the max you can go to without implementing a special, or there's no way, you're going to have to implement a special no matter what dollar amount you're taking a look at.
But I guess here's where it comes to what we talked about before. I'm assuming if all of a sudden they're looking at this now at budget time, okay, is it something that just happened that now you have to do an emergency on this? Or is it because you weren't looking out ahead of time for this and this was something that was supposed to be budgeted? So this is one of the things we've talked about over and over again, that if this was something that you knew was coming up, you want to start this whole budget process, not in July or August, but you want to start it 6 months earlier so you can start looking at these things again that are coming up. Is that correct, Brian?
Correct. And the other thing you have to look to is, what have you budgeted for in previous years? If your reserve study shows you were allocating $20,000 a year for the roof, well then damn it, man, if it's 5 years later, you should have $100,000 dedicated just for the roof. And if it's where's the money, well, then you haven't been utilizing your reserve study and haven't been allocating your reserve funds appropriately.
But if that line item's in there, that money could be used or allocated
Correct.
for loan payment too.
Correct.
Okay, our next question. Our management company recently obtained 3 loan proposals. The proposal said that the proposal letter in its entirety is confidential, but they were discussed in detail at an open meeting. Was this inappropriate? I guess if they name the bank, I would say you probably shouldn't do that. What I've seen done is they do a spreadsheet, and in the spreadsheet, they put bank 1, bank 2, bank 3, and then they look at common terms, either 1 year, 2 years, 3 years, what the rates are, what the fees are, and they compare it that way, not disclosing what bank provided the information.
And I think anytime somebody says it's confidential, it should be that. Why are any information out? I understand transparency, and that's the biggest thing we've heard yet today is transparency and where you're at with the budget.
But I think you can do that without disclosing
Correct.
who provided that, other than having the board do it. Okay, if you know a huge expense will be coming up in 10 years, like a new roof, and the reserves will not be enough to cover this expense, can you institute a monthly assessment that is to go toward only this expense and keep track of it in a special line item in the reserves over the 10 years? Knowing also that you will still have to institute a special assessment at the time of the actual work to cover the remaining costs that the monthly assessment over the 10 years isn't covering. I would say yes, but
I would agree on that, yeah.
No, absolutely. I mean, absolutely. And I have associations, whether it's for painting or from other large expenditures, that they do allocate out a certain amount of that reserve expenditure, or in painting, a contingency type expenditure, but they allocate a certain dollar amount and they put it into a separate account altogether.
And I
So
think
they
that's what
know,
they're mentioning
right,
there.
so they know the money is going into that separate account. And so then when it gets to that point, they use those funds for it. And then it goes to whether you have enough funds or not, then you make a different decision as you're going forward and getting closer to
and
that.
I knew one association that had about 5 or 6 different separate accounts that were allocated towards certain expenses that were, down the road that needed to become. And I think it's a prudent way of lessening what the special assessment is going to be down the road.
And I think if you add a little bit more, so if they're saying, hey, it's payable over the 10 years, and if you go with easy numbers, $1 a year, well, guess what? If you put $1.50, because you know what? It had a useful life for 10 years and it's rearing its ugly head after 7. If you've only collected for the 7 years worth and you need 3 more years of funding, no, I would think that you have your funding up front. Have that ready to go at 7 years. If it knows it's going to be needed at 10, have yourself, or at least a major portion of it, to what you just said, reduce the need for that much more of a special.
Right, and I even have associations that do a detailed reserve budget. So what they do is they allocate out all the major projects on an Excel spreadsheet. And they put down how much of that reserve assessment is supposed to be allocated to all the major projects. And then when there's expenditures done for that, they show on the Excel spreadsheet how much has come out of that money. And so now you know what you got left. If there's excess, then you can allocate it to your other project or use it going forward. So I do have some associations that will do that Excel spreadsheet instead of getting 5 or 6 different accounts. They think it's much easier to do it that way. And then again, you also have to look at your bylaws and declaration. What does it say about that? Because I think, if I remember, that was one of the issues from the Palm case, that they weren't doing that detailed.
Correct.
Is that correct, Brian?
Yeah. And again, the transparency, the more information you can put out there and in a healthy manner. Too often residents want to know exactly, and they want to all chime in. No, you didn't elect your 3, 5, or 7 board members only for you to come back and say, as an association of 200 units, we want to input on every line item on the budget. You never get your budget done.
Okay, next question. How specific do reserve line items need to be listed in the annual budget? For example, if landscape renovation is planned, can it then be decided later on exactly what is done where?
Of course, yeah. If you have the captured landscaping and, proposal 1 calls for these 3 items, but then you get to that date and you decide to do 5 items, the money's there. It's all under landscaping. So what portion of the project changes, whether it's spending less money or more money, that's again a board decision, but you've got it. It's another thing to say, we're allocating $30,000 for landscaping and now you want to pay for a plumbing project. What happened here?
Right. And you want to have the separate items right on your budget of what reserve items you are going to be doing, because now when they're incurred, you want to compare, here's what we budgeted, here's what the actual amounts are. So you do want to have that in your budget of what are you allocating in the current year for these type of reserve expenditures.
Okay, if a budget line item is established called Contingency Fund, can it be funded from a portion of the monthly reserve contribution that is budgeted?
Well, if it's a contingency for operating expenses, no. I mean, if this is a monthly reserve contribution and you're basing that monthly reserve contribution based upon your reserve study that you have, which is again only a guide,
Right.
so you can't necessarily use those type of operating contingency expenses to be paid out of your reserve assessments.
I agree with you on that, Steve. And I think that, and let's not lose sight of something. If you're going to have an operating contingency fund, reserve, if you think about it logically, reserve is nothing more than one massive contingency fund. It's what you think
Right,
may be happening, right?
right.
So strictly an operating contingency is what we're speaking of.
Right.
And I don't think you want to see that rolling through. And no, you're going to allocate $20,000 towards that fund, and it's not going to be funded on a routine monthly basis or draw.
Okay, next question. We have a reserve study, but can you address the need for the board to address all the needed capital projects together to get a snapshot of the financial health of the association? Too often boards check the box and get a study done, then put it on a shelf without considering it in the budget process. And I think, Steve, you talked about
I think we've
this.
talked
Yeah.
about that many times already today.
Right.
Yeah,
And it's
I mean,
a
you
living
gotta
document.
use it.
You
Yeah.
have to use it, right. And so the question there was,
And just because you're not gonna fund one of the items on there, you could still, I mean, address it, right?
Right.
Whether you're gonna push it forward, whether you're going to, you still can talk about all, and it's really up to the board and how they're gonna fund it in the future, right? I mean,
I think-
as far as,
well, I think the discussion at first is all, right? What is all out there? Okay. And then in reality, you're not going to get all done in this particular year, but then that is your 3, 5, 7-year budgetary process going along with the reserve study. And yes, at one point, you do have to address all, but it's for a discussion point only. And then it's factoring in when you will get that all done.
okay. Can you borrow from reserves to pay an insurance claim copay that is $20,000 plus per claim?
I think we kind of talked about this
Right.
earlier too.
Well, yeah, all you're doing is creating a due to, due from. Yes, if you don't have the money in operating to pay for the claim because you didn't budget it, I mean, certain budgets will show a line item for $20,000 deductible or
Right.
25, right? If you're not going to put that on your budget and you have to tap into reserves, you're creating that due to, due from, and you'll have to put that money back based on what your declarations say, what your accountant says.
Right, and make sure, again, I always like to have it detailed in your budget, in your minutes,
Right.
and with some type of a payback term, it's nice. But if you're gonna do it within the year, like we talked about before, then that's fine.
Next question. How does the manager who compiles data with detailed narratives and justifications that procedures that produces an increase that exceeds the expectation of the board? So how does the manager who compiles data with detailed narratives and justification that produces an increase
I
that
understand what they're
exceeds
saying.
the expectation of the board?
The manager has busted their hump day in and day out, hours on end, calling every vendor possible to get the most accurate proposals, right, for cost on every item imaginable. And they present this detailed report to the board and says, this is going to require a 6.5% increase. And the board goes, actually not, we're not doing anything above 2.5. And what the question there is, how does a manager work? Well, it comes down to communication. It comes down to, well, what they're saying is that all the information they've gathered, the narratives and the justifications, they've produced all of this data, and yet the board is going to turn a blind eye to it. There's where then, as a manager, you have to go back and say, okay, you've answered the board's wishes and questions. You've looked at all of what they've wanted to do. Now you're going to have to separate out those wants and needs. And if they really want to be at that 3%, then you're not doing that new party room. You're not going to have as lavish of a Christmas party because your social fund is at $20,000. Well, it's time for pig in a blanket instead of filet mignon, and you get that down.
Right,
But
I mean,
that's
you've
where the
done
manager's
your
coming from.
job,
You've
but
done
it's really
everything
the
you can.
board that's gonna make
Right,
the
and
decision.
unfortunately, that
And
is,
you have to live with it. I mean,
that, you know what, the manager has to live with it. No matter how you try and justify it, the board is always going to come back and say what we're going to spend.
And as long as it's documented, and as long
Correct.
as it's in the minutes that it was in there.
And
And
you
the
still have-
manager, but the manager has to clarify that too, Pete. You're
Right.
absolutely right. The manager says management recommendation is $20,000. Board has stated they only want to put $7,000.
Right.
And as long as that's written out, that's going to relieve the manager from liability management company.
Excuse
And
my
if-
French, but it's CYA, right?
Correct. And then it puts the onus back on the board. And what board
Right.
member wants to sit there and go, wow, you know, the roof is caving in. I guess we should have put more money towards that, right? Nobody wants to look bad.
And again, the key thing too is you have to have a balanced budget.
Correct.
Okay, part two, basically, can a property manager overanalyze a budget and can narrative serve as notice? I think, I don't know whether they can overanalyze it. I mean, more information is more information and,
I'm not questioning, well,
Yeah,
can the narrative serve as notice? I guess, does it serve as a notice that they have overanalyzed it? Because
I
if
think
you-
that's what she's saying, but I think it should be, as we said, don't you think it still should go in the minutes of what the analyst,
yeah,
what
so
the
it's already-
recommendation is?
Right, you have your budget show, you have your backup information, you have all the proposals from vendors that have given you the solid numbers. It's not like you just sat there and pulled something out of the sky. And so your narrative, you don't want to overkill either. The board needs to know exactly what they're up against. If you give them too much information, it's too much to digest. And it's really ultimately what they're looking at. Is this going to cost us a 2% or a 7% increase in assessments? That's what the argument is always at.
I think we're like 4 minutes short of 2:30, so
We
unless
covered all-
anybody has.
Pete, you just
anything
want to
say?
mention again about your handout on the.
Sure, I
real
mean,
quick?
it's, you know, what banks are gonna look for if you're gonna go for a loan, they're gonna want a description of the complex, they're gonna wanna know the size of the association, they're gonna wanna know owner occupancy, they're gonna wanna know if there's a concentration of investor owners in the unit. They're gonna ask for financial statements, current and prior, a delinquency report, a current budget. This information's all in the Q&A. They're going to want to know what you're going to use the money for. They're going to see insurance policy, board minutes. Usually they'll ask for current and prior, just to see if the project has been talked about. Also, most banks will want you to, in the minutes, approve the bank and the loan dollar amount. They're going to ask for a current reserve study. They're going to ask for copies of bids if you have them, but before they fund, they'll usually ask for the actual contracts and an engineering report. So those are all the items that will require from step one to when we close the loan. To obtain a proposal, they'll probably ask for your current budget, year-end and year-to-date financial statements, a delinquency report, owner occupancy, and just a description of the dollar amount and what you're going to use the funds for.
Okay. And I just want to make sure everybody knows that if you want to hear back on anything that we told today, that this presentation will be on YouTube. And it's also going to be recorded on CAI. So if you go onto our CAI's website, you'll be able to see the recording of this also.
Okay, we got a couple more minutes. We can do 2 more questions if I can read them and see them. The first one is, how do you fund a much needed roof replacement? The association was self-managed, had a very low reserve fund when hired a property manager who reviewed and say they can't afford to have a special assessment. Well, again, I guess what you're saying is you were self-managed. There's a roof project that needs to be done. Reserves were low, and the assessments are low, and you still would not want to budget and increase their assessments to cover the roof replacement. Say they can't afford to have you're in a bind. I mean, you got to do one or the other. You're limited as to what you could. If you go for a loan, the bank is going to want to see either a special assessment in place or additional funds, either by contribution to your reserves or an excess in operating budget that would be able to handle the repayment of the loan. From a management standpoint, do you want to add anything? I mean, I don't know what more they can really do if they don't want to increase assessments or implement a special.
Right. And well, and the other thing too, then, is going back to your consultants, your advisors, your engineers, and understanding that it is a roof project, and can it be divided up over years, where you're taking small portions of the roof and paying for it and doing the work accordingly, because you only have to pay for the work that's done, right? And the materials used. And so can you divide this project up over years? Because you certainly have monies being contributed to reserve, you have the assessments coming in, and you have to be prudent about cutting your other costs to then be able to further fund this roof project. You're gonna have some lean years ahead of you.
Yeah, and this could be also one of the ones that you would talk about, Pete, where maybe they take out a line of credit for a couple of years to keep down the, so that they don't need, God forbid, a large special assessment. They can just increase their assessment and then try to determine how what they're gonna do after the line of credits over
Yeah.
in a couple of
And
years.
if you want to contact any one of us, it was said, we said it fast, you can contact the CAI office and they could give you our contact information for all of us.
Yeah, they'll give
Do
us all
we have
our
time for
emails
one
and phone
last
numbers.
question, or are we? I think we're done. So thank you. Hope you learned something here, and have a good day.
Okay,
Thank
thank you.